Joined just now, Ashwini, we were almost in a graveyard 3 months ago. You know, the feeling of it was the feeling of a mortuary. Now everybody's feeling that the carnival is back. The problem with this carnival is that even though the carnival is in town, very few actually have bought the ticket to it, which means both in terms of participation levels and also in terms of actively trading. It's a strange world, isn't it, Ashwini? That's what I'm trying to say.
Hello, can you hear me? Hello? Hello, can you hear me?
Ashwini, it almost felt like, it was almost like a graveyard feeling when markets fell in the month of March. But right now, it feels like the carnival is back in the town. The problem with this carnival is that very few actually have the entry ticket, which is that the participation levels are low on the institutional side, and very few actually are convinced that the levels what we have are here to stay.
Yes, that's right, Nikunj. What's happening is that there's been a massive amount of liquidity that's come into the market, and that's driving up stock prices. It's not different from what we are seeing elsewhere in the world. Central banks across the world have pushed money into the hands of people, households, and a lot of that money has gone into the markets. In India, we are seeing a similar situation where for about 2 years, the Indian market was very tight on liquidity, and now we have significant amount of surplus liquidity in the system. And that's causing some of it to percolate into the market. Like you correctly mentioned, the institutional participation has been relatively muted, at least in the secondary market. But the institutions have been participating in the primary market, where new fundraisings via rights issue, via QIPs, and now the IPO market is also opened up. That's starting to come back. So it's not all sort of gloom and doom in terms of people who haven't participated. I think slowly people are looking at opportunities and are starting to participate. Of course, there is an overarching fear that the economy isn't doing well, and there's a huge amount of retail participation. So is this the classic market up yet again?
So what's been the tone of your activity in last 2 or 3 months? Where have you added? What have you subtracted? Where have you taken some chips off the table? I'm just trying to understand that how are you viewing this market?
So I don't know if I had mentioned this in one of our prior conversations. At the end of March, when we sat down and said that, okay, fine, the economy is going to be in a tough spot. What do we do? So we said that, we are going to move our portfolio along 4 axes. First is focus on necessities over discretionary. Every product, falls somewhere on that scale, where on one extreme you might have a complete discretionary demand like, going to a carnival, as you mentioned, or at the other end you would have a complete necessity like buying toothpaste, and everything else is, somewhere in the middle. So try and move as close to necessities as possible. The lower the discretionary element, the better it is. Second, which I'm beginning to realize is probably a bigger theme than even necessities over discretionary, is leadership. I think because the market is in a tough spot, because there are select people consuming, because banks want to lend very carefully, I think leadership is going to play a major role in winning market share. And I think, that's something that intuitively we felt that in times of trouble, you should move more towards leadership and get out of number 3, number 4 market share players. So that's something that we've done. The third is to focus on balance sheet quality. I mean, it's not that we were buying over-leveraged companies earlier, but the focus on cash flows and focus on balance sheet has become even more important. And lastly, focus on export. Because my sense is that the Western economies might come out of this with fewer cuts and bruises than India will. So in a sense, what I'm thinking is that the recovery in the markets in the Western economies, or the recovery in the Western economies, to be more precise, is going to be a little bit earlier as compared to what you might see in India, which might be a more deeper U, or somewhat of a L-shaped recovery, if these letters make any sense.
Ashwini, can IT do what FMCG stocks have done last couple of years? Because now, because of the base effect and the new focus on digitization of the world, IT companies can well give you a double-digit return. Their P multiples are low, dividend yields are strong, cash flows are strong. I can just see so many parallels what I saw in FMCG stocks, let's say a couple of years ago versus IT, purely in terms of the appeal they have. Do you agree with this thought of mine? I mean, please feel please feel free to smash it if you don't.
No, Nikunj, I agree with you. So they focus on, so if you think about the four parameters that I pointed out, A, it's export-led, B, very strong balance sheet, C, you have plenty of companies which have leadership in their chosen area of expertise within the broader domain of IT. And last but not the least, I agree with you that a lot of the services that they provide have a lower discretionary element than we probably appreciate. So within the IT space, I think discretionary projects might be put on hold, but I think providing mobility, providing work from home, providing additional layers of security, providing e-enablement of business architecture. I mean, these are all things that should have been done yesterday. So people who haven't done them are going to rush into doing them. So I think, yes, IT services is in a good place. Now, whether they'll give the kind of returns that consumer stocks gave over the last 2 years or not, I don't know. But yeah, I am favorably disposed towards IT services is the way I would put it.
Ashwini, Nikunj and I were just chatting earlier this morning that this is a peculiar world. You've got safe haven buying in gold. It's at a 9-year high. Silver as well is in a tizzy. And you've got equity markets also holding up. You think the key is in the dollar index movement, and where do you see it headed next?
So, these are very difficult predictions to make. Our view has been that the US dollar should structurally weaken. It has been extremely strong for almost a decade now. And with the kind of deficits that they are playing with, and the kind of slower growth that we are anticipating, one should expect the US dollar to weaken. Now, the problem is something like this. Okay, what does US dollar weaken against? Does it weaken against real assets, which is gold, as you pointed out, or commodities, or other real assets like real estate, etc.? Or does it weaken against emerging market currencies? I'm less convinced about the latter, but I think the former sounds like a promising argument. However, if you look at what Yan Den, our global strategist, often talks about, he does expect the emerging market currencies to do much better than the US dollar, for the simple reason that the external account or the fiscal account deficits that are being run in emerging markets are far lower than what we have seen in the Western world. And these economies are much better positioned today than they were at any point in time during the previous crisis in terms of the kind of imbalances that they were running with. So I think yes, there is a case for that, but let's see how it plays out.
Okay, fair enough. So definitely building in some of that. In terms of the kind of performance you also see going forward, Ashwini, is there perhaps a strong case building for some of the other EMs? How confident are you of India's attractiveness in the overall scheme of things now going forward?
So, Aisha, let me just take a step back and say that there are different challenges for each individual market. Some markets are very significantly driven by specific commodities. Some markets do have a problem on their fiscal side or a problem on their external account side. And I think India has its own set of problems. So I think we're living in a world where you have to do a lot more analysis on each market and make up your mind where you stand. I think while what you point out is right, that India probably, or what you implied probably is right, that India is relatively expensive in the emerging space, and the fact that we probably have a bigger fiscal deficit in the short run than many other emerging economies. I also think that a very large domestic demand and a reasonably healthy banking sector are positives. I mean, I think the bulk of our NPL pains have been provided for in the last 3 or 4 years, and that's what the first crop of the June quarter results seems to be showing us. And if the asset quality holds up, this could be an area of a very big, large positive surprise. Intuitively, of course, one expects that the NPL numbers should go up as we go later into the year. Given how slowly the demand is coming back, it is anybody's case that borrowers, will have problems, down the road. But so far, that stress is not visible. Maybe it's the liquidity that's helping. Maybe it's the fact that, domestic entrepreneurs are so used to, lifting themselves up by their bootstraps that they will yet again find the resources and the ability to bounce back just as they did post-Demon and post-GST. And, yes, this will cause some delays, but loss given defaults will probably surprise the markets on the lower side. Let's see how that plays out. So I'm reasonably positive within the EM framework on India. Yes, there might be some more positive, better markets out there, but I'm an India specialist, so I wouldn't be able to comment much on which specific markets those would be.
Sure. Ashwini, you touched upon the financial sector, so I want to explore that with you. You said it's looking healthy, and this time we haven't seen those concerns that we had earlier with respect to the health of the sector. Agreed. But given the kind of period that we're going through and question marks around NPAs and moratorium, even though the current data indicates that we're well placed, do you see any kind of risk that needs to be factored in, or are you quite confident given the kind of commentary that's come in from some of the leading banks so far?
See, as I mentioned, if you zoom out and you think about it, you should expect more credit losses. The question then arises, where are those credit losses going to sit? Are they going to sit in NBFCs? Are they going to sit in MFIs? Are they going to sit largely in PSU banks, which have been pushing a lot of the Mudra loans? Or are they going to sit in the large private sector banks that have focused on credit quality over the last 3 or 4 years? So the case I would make here is that the private sector banks are probably much better positioned than the aggregate banking sector. And the case I would also make is that NBFCs, which have parentage or a rating that will allow them access to funds, are probably in a good place. So, those are the two areas where I feel reasonably confident that the asset quality problem will not blow out of proportion and will be reasonably managed. And the financials will be able to muddle through it. Now, inherent to this statement of mine, I would say that I'm assuming that there is no second big wave of COVID-19, which leads to much longer and much deeper downturn than what we can imagine right now. The central government and local administration in many places have clearly said that the economy needs to continue to operate, and most administrations are no longer in favor of continued lockdowns, hoping that we can manage the health crisis without having to shut down the economy, and that's the assumption I'm going with.
Ashwini, what is your view on some of these modern platform companies in India, whether it is the India Mart or MCX or India Energy Exchange, Bombay Stock Exchange? The world is migrating towards platform. Reliance Jio, which was a telecom company, has become a digital service company. Amazon is getting its valuation because it's a platform company. Microsoft, when they moved into Azure, the cloud platform, they got re-rated. This is the mega trend, Ashwini, in the world. In India, does it make sense to either buy an MCX or perhaps a NSE? NSE is not listed, but let's say BSE or India Mart or India Energy Exchange?
Well, yes, some of these businesses have very, very enduring moats around them. It's not easy to be an exchange where a bulk of the volume of the commodity that's traded trades on your exchange, and regulatorily you're required to trade on the exchange, and these are virtual monopolies in some cases. Of course, India Mart is not a regulated monopoly. It is a monopoly because of how it's positioned itself. But, I don't want to comment on individual stocks per se as to what's good, what's not. But what I would say is that if there is a leadership in a business, again, going back to the 4 points that I mentioned, and you have a good balance sheet, and you think that the company is doing things that will continue to allow it to remain a market leader, and therefore it can, add products or services to the bouquet of products and services that it already offers to its clients, then I think it's in a good shape. I'm a big believer that leaders will become much stronger when we come out of this crisis, because they are the ones who have the balance sheet, they are the ones who have the customer connect, and they are the ones who are winning all the market share. And I think that applies to the names that you mentioned as much as it does to many other companies as well.
Throw a headline at you, Ashwini. Government is saying that they will not be in a lot of non-strategic sectors, and they want to retain 1 or 2 big companies in strategic sectors, which means a whole host of companies are likely to be divested. If this is the headline, and if you read this headline as an investor, would you react to it? Would you like to hunt for something in that space?
Yes, of course. I mean, why not? Some of the government-run businesses or PSUs have fantastic franchises. They have great assets, and they're reasonably well run. We suffer from this impression that PSU companies are slothful, lethargic, or they misuse capital. Well, that might be true in some cases. In many cases, it's not. Many cases, these businesses are extremely well run. Of course, their executives, etc., don't appear much in public, and familiarity in some cases may be somewhat less with the general investing public. But these are great businesses. They offer very good dividend yields. They offer great valuations. And in the right hands, these assets could be worth a lot more, from a market perception point of view. So, assuming that the government does go through with this, and they manage to privatize, BPCL to start with, as they have stated, and more companies follow, I think there could be a huge amount of value unlocking that can come through in the PSUs.
Well, Ashwini, appreciate your time. So glad to have you back on ET. Now, let's take a break with the news that today it's one of those unusual days that despite good set of numbers, Axis has slipped from the day's high. Markets, meanwhile, are showing signs of getting tired. I don't want to use the word reversal, but if I have to really look at the initial set of commentaries which have come out from the companies, whether it's Infosys or TCS or Axis Bank or HUL, the word fear is out. The word optimism is back. All managements earlier were saying that they were cautiously optimistic. Now they are saying they are optimistic, and it's only a time that things will start recovering. Is that the trend, at least for the branded luxury sector, the branded retail sector in India, how that has suffered, what are the trends, and if buyers are not back in malls, what is the future of branded retail sector in India? Much more on that with an authoritative voice, Darshan Mehta of Reliance Brands. But right now, break. After that, there's interesting discussion and chat.